Well, hello and welcome to the Wilson Pateras webinar. Today we're presenting to you the JobKeeper Alternative Decline in Turnover tests. Thank you all for attending this morning. This is now the third session we've in fact had on the JobKeeper JobKeeper scenario, and we look forward to being able to share some information with you today. Of course, JobKeeper is something that has been around in our business world now for some 6 months, but there was some recent changes, and around 2 weeks ago, the eligibility for JobKeeper was opened up to many more recipients. And what we're seeking to do today is to explain to you the alternative tests, which will allow many more businesses to receive JobKeeper entitlements. So today I'm joined by Mark Forte of Wilson Pateras. Mark spends much of his time working on quite complex tax and technical issues within Wilson Pateras, and we're very fortunate today to have him to talk about the alternative decline in turnover test. So, hello, Mark. How are you?
Oh, very good, Nick. Very good for a Tuesday morning on pre-budget night.
Yes. It's a big day. It's a big day for for not just the accounting world this time around, but also the broader Australian business community as we also await those budget measures which will be mentioned and put forward tonight. So for today's session, we'll expect to go for roughly sort of 45 minutes. You'll notice on your screen there'll be a question and answer box. So we invite all of you to put forward your questions throughout this session, and I'll attempt to bring Mark in to answer those questions where possible, but we'll also answer those questions at the end. So yeah, please participate where you can. And we'll also have a poll. So I'll be launching a poll in a few moments. Please answer the questions in that poll because it's helpful for us to know what we can focus today's sessions on to help tailor the session for your particular needs. So without further ado, I'll hand across to Mark, who will now do the presentation.
Okay, thank you very much, Nick. So today's, that's our disclaimer, what needs to do. So today's session, a bit of an overview first, is going to be 2 parts to the session today. The first one is a bit of a JobKeeper refresher. So with that, we'll just go through the fairly basics of it in terms of employer eligibility, employee eligibility. We'll touch on in terms of the 2-tiered payment rates and I suppose number of fortnights in this current JobKeeper period. And then part 2, which is a bit more involved, we'll look at the different alternative tests. So I'll go through the summary of 5 of those tests, and we'll go through a work example or 2. And just to round off the session today, we'll look at some key upcoming dates to the middle of November. So moving right along, in terms of just JobKeeper overview in a nutshell. So what we have here is just a bit of a graph. I'm sure most people will be familiar with it. So JobKeeper 1, that expired no more than 9 days ago now. So that ended on the 27th of September 2020. And we're the first week into JobKeeper 2, the first tranche of JobKeeper number 2. And that will end on the 3rd of January 2021. And then we have to go through the process all over again from the 4th of January to the 28th of March 2021. So for each period coming up, which is the one that we're in the middle of at the moment, or at the start of at the moment, and the one on the 4th of January, there is a re-enrollment type of process. I mean, if you're already enrolled for JobKeeper, you are in, but then we have to re-enroll and resubmit declarations about declining turnovers, and we'll get through that later on in the slideshow. Just a bit of a, call it an interesting fact, is that if an employer was enrolled in JobKeeper right through the whole 12 months, from the 30th of March 2020 to the 28th of March 2021, if there was a full-time employee and that employee was entitled to JobKeeper, that employee would be paid $33,900 in JobKeeper payments. On a lower rate, and we'll get through lower rates in a bit later on, a part-time employee, for example, would be receiving, if they're enrolled in the system right from the very start, a payment of $28,650 right through the JobKeeper period. So it's a fairly generous concession, very generous subsidy that the federal government has provided. So I thought that was something that was interesting when I crunch the numbers. So if we move on to the next slide. Okay, just going through entity eligibility. yeah, there we go. Entity eligibility. From an employer's point of view and non-employer entities, just looking at the employer eligibility first, well, they should be fairly well known by now. From an employer point of view, you carried on a business as at 1st of March 2020. You've employed at least one eligible employee on either the 1st of March or the 1st of July 2020. Those employees are currently employed for the fortnights that you are claiming for. And most significantly, all the type 3 doesn't really matter if you haven't experienced a significant fall in turnover. So that is the crux. If you experience a significant fall in turnover, and we'll get to the percentages fairly soon, then you'll be eligible for the JobKeeper payments. Non-employer entities, and there's probably 3 which are most common. They cover sole traders. They will cover a beneficiary of a trust where that trust does not employ that beneficiary, but that beneficiary actually does work in the business. And also the same would apply to a shareholder, where the shareholder of a company is not employed by the company, but does engage in work for that company on a significant type of basis. So in terms of non-employer entities, again, very similar, must carry on a business on the 1st of March, experience a significant fall in turnover. That sole trader, beneficiary or shareholder, who we term an eligible business participant, that's a technical term, must be actively engaged in the business. So what does actively engage means? It means you have a direct control and running of that business. So it's not one where you might work for an hour per week in that business. I mean, that wouldn't really cut it to be actively engaged. If you're working 30 hours a week in that business, then I think it's a very, very strong argument that you are actively engaged in that business. The next one, point number 4, you are not an employee of another entity. So this is probably a very good example of that would be a medical specialist. A medical specialist may run a private practice in their own name as a sole trader, but what is fairly common is that that medical specialist would also be employed at a public hospital. The very fact that medical specialist is employed in a public hospital as an employee means as an eligible business participant, they cannot receive JobKeeper. They can receive it as an employee from the public hospital if that public hospital meets the decline in turnover test, but they cannot receive it for itself. But that's not to say that the sole trader cannot employ people and receive JobKeeper for their employees. So it's a very subtle type of difference. And the 5th one there, that the eligible business participant has not previously given another entity a JobKeeper nomination form. So that's that in a nutshell. Employee eligibility. Just go through this one fairly quickly. The obvious one is that you must be employed at any time in the fortnight up to the 1st of July. There's an age condition where the minimum age is 16 years or over, provided that person is independent, not a full-time student per the Social Security Act. Obviously, must be employed for part-time. Must be a long-term casual. And what that means is that you must be a long-term casual for at least 12 months as of the 1st of July 2020. So if a long-term casual started in your business on the 1st of August 2019, they will not meet that definition. So they must be working from you from at least the 1st of July 2019. And just to further on that point, what a long-term casual is, is someone who has regular and systematic employment with you. And obviously there's a residency condition as well, where you must be an Australian tax resident. So that's all fairly quick. It's just really a very brief overview. So we'll start getting into the more meaty areas of JobKeeper now. So what's very important about this slide, or the key part there, is the payment rates. So if you look at that middle column there, between the 28th of September 2020 and the 3rd of January 2021, there are now 2 payment rates. In JobKeeper number 1, that ended about a week and a bit ago, was 1 payment rate for all employees, whether they're full-time or part-time. But now there's 2 payment rates. And it is all prefaced on how many hours that you have worked in a particular reference period, which is an 80-hour threshold. And I'll go through that in the next slide. So the other payment rates up to there, so it's $1,200 and $750. $750 per fortnight up to the 3rd of January. And if you're able to qualify for JobKeeper, we'll call it JobKeeper 3, the 4th of January 21 to the 28th of March 21, you can see that how the payment rates have declined. And as the government puts it, to wean people off JobKeeper in a slow but steady type of fashion. The number of JobKeeper fortnights in the current JobKeeper period that we're in, there are 7 fortnights altogether. So this table here shows you the dates of those fortnights. It ends on the 3rd of Jan. As you probably will know by now, for people who are already in JobKeeper, JobKeeper number 1, you must submit a monthly declaration, which is due by the 14th of the month after. So for JobKeeper 1, for JobKeeper 2, for the next payments that are coming through, as soon as you lodge your monthly declaration, and the sooner that you lodge it, the sooner that you get paid for the employees. So you can expect a payment for employees or an eligible business participant that's on a full rate of $2,400 and a partial rate of $1,500. We move down to the payment on the 14th of January, where it includes 3 fortnights. This one I might make a bit of a disclaimer, but this is the first period of which the JobKeeper payment for those applicable fortnights crosses between 2 months. So to me, logic says that payment will be on the 14th of Jan for $3,600 and the partial rate of 2,250. Otherwise, that payment for that fortnight between the 21st of December to the 3rd of Jan may be in February, which doesn't really make a lot of sense to me. So it's sort of more about what you face at the moment. So they're the payment rates, they're the monthly declarations, which is an obligation on everybody to put your declaration in by the due date. And as I said, the sooner you put it in, the sooner that you get paid. And as you can see, just at the bottom of that table there, if an employee or eligible business participant was on a full rate, they'll receive for this current JobKeeper period $8,400 in total of JobKeeper payments, and under a partial rate, which is more for part-time employees, $5,250. So we'll move on to the next slide. And this one I'll spend a bit of time on. This is when I presented, I think Nick was about 3 weeks ago now, and we talked about changes to JobKeeper and what was happening. I sort of spoke about a 20-hour per week reference period, where you must work 20 hours per week for the month before the 1st of March or the 1st of July. With recent legislation that went through, that has changed to an 80-hour period. And I'll just explain that as we go through the slide. So if the JobKeeper recipient is an employee and they wish to receive the higher rate, then they must work at least 80 hours. They must work at least 80 hours in the reference period. What the reference period is for an employee is the 28 days ending in the last pay cycle before the 1st of March or the 1st of July. So as an example, if the pay period before the 1st of March, the last one ended on the 15th of February, and it was a 1-month pay cycle, so it began on the 16th of January, that is your measurement period. Bear in mind that the pay cycle for the 16th of Jan to the 15th of Feb is 31 days. We can only do this for 28 days. So therefore, if an employee worked for 85 hours during that pay period, for that 1 month of 31 days, you have to prorata that 85 hours. So the way you do that is 85 hours multiplied by 28 days divided by 31. And that calculation comes to 77 hours. Because it's come to 77 hours, you will not get the higher rate of JobKeeper. You will get the lower rate. So that's just a point to note. Obviously, there's different pay cycles, different businesses has monthly or fortnightly or not be fortnightly or weekly. So you really need to do that type of calculation. So just going back to the word leave, the higher rate applies if hours worked including leave includes at least 80 hours. So what does leave mean? It means annual leave, long service leave, personal leave, sick leave, employer paid parental leave, but not government paid parental leave. So basically, you include all that leave, and that's part of those 80 hours as well. It also can include overtime as well. So the key concept about the 80 hours is the actual amount of hours worked during your reference period. So leave is taken to be hours worked. What it doesn't include is time in lieu or rostered days off or unpaid leave. So you've got to be very, very mindful of that. In terms of eligible business participants, it's a bit different. They must be actively engaged for at least 80 hours during their reference period, and their reference period is February. They can't even go back to June. It is just 1 month. It is February 2020. And what the eligible business participant must also do, they must provide a declaration. If they are a sole trader, they provide that declaration directly to the Australian Taxation Office. If they are a shareholder in a company or a beneficiary of a trust, they must provide that declaration to the entity, and then the entity will then inform the ATO in terms of the 80 hours. So what happens in the case, I mean, how do you account for this 80 hours? I mean, at Wilson Pateras, we do timesheets where it's easy for us to account for our hours. When I first had my first job, which was at, actually was a trainee cost accountant back in the late-ish type of 80s, as I was going through university at La Trobe, we had clock cards, believe it or not. I worked in a manufacturing plant and we had clock cards. So as soon as 8 o'clock came in, you clock on, 4:30, you clock off. So that's very easy for them to determine how many hours that I actually did work. But what happens if you have insufficient records? Well, in this case here, and this is on the AHL website, the higher rate will apply if an employee has been paid $1,500 or more during their 28-day reference period. So that's fine. It's pretty obvious that you've worked more than your 80 hours. Number two, if you've worked more than 80 hours and you've got an employment contract in place under an industrial award enterprise agreement, and one of those legal documents say that you're a full-time employee, or your hours are more than 80 hours per month, or per month that you have to work, and then you'll be able to achieve the higher rate. And the other one, which is very subjective, is based on reasonable assumptions that the hours are worked more than 80 hours or more. So there's a good example on the AHO website. It talks about an employer who owns a bicycle shop. So they sell bikes, and he has one employee, and that employee's job is to assemble bikes. In the month of February, the total amount of bikes sold was 48 bikes, and the employer estimated or calculated that to assemble those 48 bikes, it takes 2 hours. So 2 hours by 48 bikes that was sold in Feb comes to 96 hours. Therefore, the employee has worked 96 hours, therefore greater than the 80 hours. And in that case, they'll be applicable for the higher rate. So that's sort of something like you might have to go through. So you have to make reasonable assumptions, document it, because if you ever do get an audit from the ATO, we'll be requested to provide how did you work the 80 hours, particularly for the part-time staff. So what this is really all saying to us is that full-time employees, I mean, they'd be well and truly covered. I mean, it's quite obvious they're working there 37, 40 hours a week. But what you really do need is a clear examination of 1, part-time people, 2, long-term casuals, 3, people not paid on an hourly rate, on an hourly basis, and obviously employees that were stood down, because employees that are stood down, they're not actually worked. As I sort of mentioned before, everything's based on actual hours worked for your reference period. If you stood down, you are not working. So you have to be you do really need a very, very clear examination of those type of categories. But then you may say to me, well, what happens if the 28-day reference period isn't indicative in terms of how many hours an employee has worked? So glad that you asked the question. Reason being is that there are alternative tests that you can do for employees to work out the 80 hours. What I'll do, I'll just go through the headline situations or scenarios of which an alternative test may apply. And I'll just, so the first one is that the total hours that an employee has worked in February or June is not indicative of the normal hours that that person would work. It might be for the fact that there's unpaid leave, maybe time taken off as unpaid leave to care for a sick relative, whatever the case may be. So there's an alternative test for that, where you would go back to the last 28-day pay cycle, which was reflective of that person's hours, and use that as your calculation base. The second situation is where the person was employed after the 1st of February or after the 1st of June. So basically, you cannot calculate the hours worked in a 28-day period because they weren't working for you for that 28-day period in total. So there's another situation where there is an alternative test. So it's for new employees that began after the 1st of Feb or after the 1st of June. The third situation is where the first pay cycle for that employee ends after the 1st of March or after the 1st of July. So that might cover the situation, for example, where someone started with your business on the 20th of June. Obviously, you cannot have a 28-day reference period before the 1st of July. So what happens there is that you go to the next 28-day period where the person is working for a full 28 days and look at that pay cycle to give you what the hours would be. And the final alternative test covers a situation where a business has changed ownership during the reference period. So, example, business might change hands on the 14th of February, which happens to be Valentine's Day. And so that's not reflective because there's no 28 days there at all. So then you look at the next pay cycle, which would be the one in March, and then that's one that you can look at to base your 80-hour test. So the 80-hour reference test, in summary, there is complications. As I mentioned, it's not so much for full-time employees, but it's more geared towards the part-time employees. That's one where there's complications, and there'll be significant work that will need to be done to determine whether they do meet the 80-hour threshold or not. So what we'll go towards now.
So Mark, we just have a quick question, a question from Di Jones. Di, thank you for your question. Di's question is, how does an eligible business participant provide the declaration for the 80 hours worked in the month of February?
Okay, that will be on the ATO portal. So what we're doing at the moment, that's a very good question. So it will be done through the ATO portal. There'll be a form there that will be submitted electronically. And that's just to let you know the timing for the dates, which I was going to get to the very last slide. But you have to notify the ATO between the 1st of November and the 14th of November. So that's your time frame to notify the ATO in terms of the hours that you work. Because within that date, you have to advise on your payment tier as well. As I mentioned, there's 2 payment tiers, one for the 1250 and one for the 1200, one for the 750. The ATO do not know what payment tier to pay until you tell them of the hours worked for each employee or eligible business participant. So that is lodged for the ATO. We do it through the ATO portal, might be done through the business portal, and that's the way that you would do it, Nick.
Thanks, Mark.
Okay. So point number 2, and this is really our second part of the session today. It's all about alternative tests. And there's 7 alternative tests to cover the situations that you see on the screen. So these are just the headline situations. One is that the business started after the 30th of September. Alternative test number 2 covers a situation where there's been a business acquisition or disposal that changed the business turnover dramatically. Number 3 is a business restructure. Number 4, businesses affected by drought or natural disaster. Point number 5, a sole trader or a small partnership, which could be no more than 4 people, have been affected by sickness, injury, or leave. Test number 6, a business has had a substantial increase in turnover. And point number 7, or test number 7, covers a situation where the business has irregular turnover. So we'll just go through 5 of those in summary and 2 in a bit more detail. But before we do that, what is a substantial decline in turnover? So what I've done here is, what it says is a decline in actual GST turnover, we'll go through that definition a bit later, of 30% when comparing the September 2020 quarter to the comparison period. And that 30% is for businesses with less than $1 billion in aggregated turnover. If the aggregated turnover is more than $1 billion, then the substantial decline in turnover is 50%. And if you're a not-for-profit organisation, then it reduces down to 15%. So just turn your attention to the word aggregated. So what does aggregated mean? Say you've got 3 different companies that you commonly control, and they all got different, obviously they've all got different turnovers. You have to add all those turnovers for those 3 businesses to get to your aggregated turnover. One of my biggest clients, they've got the head office in Malaysia. They've got a branch office in Australia. The Australian entity is nowhere near the $1 billion in turnover, but when you add it to that foreign company that owns this business, you have to aggregate it and it goes over $1 billion. So they would have to satisfy the 50% test. So aggregated turnover, what you do there, you have to add basically add all your sales as your turnover from an income tax point of view. What you do not include is sales of capital equipment. Say, for example, you sold plant and machinery, you sold land, you sold motor vehicles. The sale proceeds of that is not included in your aggregated turnover calculation. So it's purely based on your ordinary sales type of income, and that gives you whether you're close to that $1 billion or not. So once you get through all that, you need to determine what band, whether it's the 15% for non-profits, 30% for businesses, or the 50% for businesses with turnover more than $1 billion. Then we use two methods to calculate whether you're eligible for JobKeeper. So the first method is the basic test, and the second method is an alternative test. So there's a basic question is, if you satisfy the basic test, you have to consider the alternative test. Sounds a bit of a silly question, but the answer is obviously not. So once you meet the basic test and you pass JobKeeper with that test, all these other 7 tests that I've mentioned before, you don't even have to consider those tests at all. So we'll move on to the next slide.
So Mark, a quick question we have here from Narissa Thompson. Narissa, thank you for your question. Narissa is asking, if you commenced your business in the September quarter last year, let's say it was on the 1st of September 2019, so you didn't have a full quarter of trading, how do you determine the decline in turnover for a business in that particular situation as you're comparing the current quarter turnover, September 20 quarter, with one that's only got a partial quarter in that particular year last year?
Okay, that's a very good question. So within that situation there, and it's probably more in 2 slides across, but what you would do, you would look under the new business test, and I would believe that even if you go to 2 slides further, Nick. Yeah. No, sorry, 3 slides. Yeah, that's the one. We've got the new business test there. When I did say the date on that, the business started between the 1st of October 2019 and the 28th of February 2020. But I believe in your case there, Narissa, the fact that you cannot compare your September 19 quarter to your September 2020 quarter, then what you would do is you would add what your average turnover is. So add all your turnover from the 1st of October 2019 to the 28th of February 2020, work out what your total turnover is, divide it by the number of months that is, which is, I don't know, 5, 6 months, 4 months, around about there somewhere. So you get your average turnover, and then you multiply that by 3. And once you multiply it by 3, you compare that to your September 2020 quarter. And if more than 30% decline, then you would be eligible for JobKeeper.
Yeah. So what you're talking about, Mark, is that the system allows you to calculate an average turnover for the periods that you were in business, and you basically compare that average with the current quarter to determine if there's a 30% drop.
Yeah, correct. So if we can just go back a couple of slides, Nick. Yeah, no, that's done. We've done with that slide. Next one more to go. Yeah, that's the one. So the basic test. So spend a bit of time on this one as well, not so much the basic test. It's all about concept. So the basic test is you compare your September 2020 quarter to the September 2019 quarter. Assuming that your turnover is less than $1 billion, if there is at least a 30% decline, then your business will qualify for JobKeeper number 2, subject to meeting the other eligibility criteria that I went through before. So if you're not registered for GST, for the reason being that your turnover is less than $75,000 for the year, then you can use the cash basis or the accruals basis for your comparison. What accruals is basically you recognise your sale once you raise an invoice to your customer. That's your accrual basis of accounting. So if you're unregistered, you can use cash or accruals, but be consistent. If you're using cash to measure your September 2019 turnover, and then you use cash for your September 2020 quarter calculation there as well. If you are registered for GST and you lodge your BAS on a cash basis, you must use a cash basis for your comparison. You cannot use cash for September 2019 and then accruals for September 2020. So if reporting cash, use cash. If reporting accruals, you use accruals. You can't swap and change. So then, in terms of GST turnover, this is an interesting concept, and it can get a little bit confusing, a little bit tricky. So just a few things to be mindful of. If you ever want to light read, you can always read Law Companion Ruling 2020/1, and it goes through what's included in GST turnover. But basically, to keep it very simple, is that any JobKeeper payments that you receive is not included in GST turnover. Any money that you receive from grants generally is not included in GST turnover. And the cash flow payments that you receive for your pay-as-you-go withholding, that's, I think, started last April. Again, that is not included in GST turnover. But what is included in GST turnover, which I think is a bit of a flaw, is that if you have sold plant and machinery, motor vehicles, land, anything like that, that is included in GST turnover. And why I believe it's unfair, because during, particularly for Victorian businesses, over the last quarter, we've been in lockdown. Businesses have been struggling to survive. So one way to help survive is to sell plant and machinery, cars, just get some extra cash in so they can make ends meet. Unfortunately, that will be included in your GST turnover calculation. So just be very, very mindful of that. And the other point that I'll make about GST turnover, and comparing it to your BAS, and everything is predicated in terms of what income that you have lodged on the BAS, but there's going to be times where GST turnover will not equal what's on the BAS. And the reason why I say that is because when you report income in G1, there's going to be input tax supplies that are recorded in your BAS, but does not form part of GST turnover. What an input tax supply is interest income, for example. It might be rent received from residential property. That is included on your BAS, but it's not included for the calculation of GST turnover for JobKeeper purposes. And the other one, which probably more affects property developers, is that if you have sold land using the margin scheme, the gross sale proceeds of the sale of that land is GST turnover. But on your BAS, you're only reporting in G1 what the margin is. Margin being the difference between the sale price and the price that you paid for your land, because that's what you're paying GST on. So there's a difference there between GST turnover and BAS and what's reported on your BAS. So you just got to be very careful that you don't trip up on that. So that's very important to note. Okay, so move on to the next slide. Just in summary, first one, new business tests. I believe I've answered that when Marissa sent through her question. So we'll go to the next one, business acquisition or disposal. So this applies to businesses acquired or disposed of between the 1st of July 2019 and 30 June 2020. So from there, you use your GST turnover in the month after acquisition, you multiply that by 3, and you compare that to the September 2020 quarter. The business restructure, pretty much a similar type of test. So basically, you use your GST turnover in the month of, which should be actually month after restructure, multiplied by 3, and compared to September 2020 quarter. Just go to the next slide. Natural disasters. So the business was conducted in a declared drought or natural disaster zone. And what you do, you compare your September 2020 quarter to a September quarter that was not affected. So say, for example, a business was in drought in 2019 and September 2018 and September 2017, but wasn't in September 2016, then you compare September 2016 to September 2020. And the final one there, before we get into the other two, is a sole trader partnership scenario. Either one can have no employees. The partnership must have 4 or fewer partners. And you use the month immediately before a person couldn't work, multiply that month by 3 and compare to the September 2020 quarter. So say, for example, a person was injured on the 15th of August. You go back 15th of August 2019. You look at the month of July 2019, multiply that by 3, and you compare that to the September 2020 quarter. Just a note before we get on to 2-word examples is that you can use any one of these tests. You're just not you're not resigned to just use one test. You can use any test that suits your purpose. So if you don't satisfy the decline in turnover test in one test, you can use another test that might get you through. So don't think that you're just locked into one test and that's all that you can choose. You can use a number of tests and use the one that best suits you. Because when you do apply for JobKeeper number 2 or re-enroll for it, the AHO will ask what alternative test you did use. You've just got to be very mindful of that when you do the application.
Thanks, Mark. We have a question from Jeff Bond along those lines, and the question is, how do you apply those alternative tests? So what you're essentially saying is that as a taxpayer, you'll look at your situation, you don't satisfy the basic eligibility requirement. You then go to look at the alternative tests, and then you make that choice for the alternative tests on your application on the business portal or even the tax agent's portal if we're doing that on behalf of the client.
Oh, that's exactly true. I had a client situation last week, and they're in the real estate construction game. And yeah, and we look at using 2 different tests. We look at using the irregular turnover test, which we'll get to in a sec, and also the substantial increase in turnover test. They didn't make it by the substantial turnover test. They didn't qualify, but under the irregular turnover test, they did. So it's a matter of going, we did an Excel spreadsheet. We'll look at each month in terms of what the GST turnover was. And then we went through these after these mechanical steps. So you're going through the different steps to look at whether we can, whether we do apply for turnover, do apply for JobKeeper. So it is a bit of a mechanical process. So the irregular turnover test. So this one cannot be used if the turnover is cyclical or seasonal. So you think of businesses that are cyclical, obviously fruit picking season. That's where a lot of the turnover is made in those type of businesses. Selling Christmas trees sort of going to happen round about now, sort of leading into Christmas. So a lot of their turnover will be over the next couple of months or so. I put in there a florist, may or may not apply, but the reason why I put a florist in there, just a thought, doesn't mean that it's correct, it's just a thought of mine, is that their 2 biggest months would be February for Valentine's Day and May for Mother's Day. That's where the turnovers will definitely increase a lot. So that, to me, that's very cyclical, because you know it will be an increase in turnover during those 2 periods. But that's not to say that they can't use any one or the other 6 tests to determine if they're eligible for JobKeeper. What type of industries would it suit? These are just sort of random thoughts. May suit construction industries where projects are not fluid. They start a project, they've got to go and buy the land and then develop all over again. So it's not regular recurring type of income. It may be real estate agencies which are highly dependent on revenue on sales commission. As we know, we're in lockdown. It's very hard to sell property at the moment because you can't inspect, or you couldn't inspect as of a couple of weeks ago. Or maybe no win, no fee legal firms where there's not a certainty of income. So if we go through the detail in terms of irregular turnover, in terms of the 4 steps. So there's 4 steps to this process. And the first one is that you must determine if there has been at least a 50% drop from the highest to lowest quarter in terms of GST revenue. And what you'll see in the table underneath step 1 is that we've got 8 different quarters that we could look at, 8 different quarters. So we look at the 12 months before the 1st of March 2020, and the quarters being, as you see on the screen, so they're not traditional best quarters. Or we look at the 12 months before the 1st of July 2020, and they're your traditional best quarters. So if we determine in any of those months, looking at highest to lowest, that there has been at least a 50% drop, then we go on to step number 2. So what we do there is divide the 12-month turnover. So you add what is the total GST turnover for either 12-month period, divide that by 12 to get the monthly revenue. Once you've got the average monthly revenue, multiply that revenue by 3 to get your average quarterly turnover. Then you compare that to your turnover to your September 2020 GST turnover to determine whether there's been at least a 30% drop. So we'll go through a worked example. Go through a worked example on the next slide. Yep. So this is, I've got this one from the explanatory memorandum to the legislation. So basically a business has a September 2020 GST turnover of $100,000. Business is not cyclical and wants to determine if they can apply for JobKeeper. So what we're looking at in those 4 different quarters, May 19, August 19, November 19, and February 2020, you can see the GST turnovers for each of those quarters. If we compare the lowest GST turnover, which is the quarter of November 19, which is $75,000, You compare it to the highest quarter, which is February 2020. The decline there is 62. Sorry, the increase has been 62.5%. So it does meet that definition in terms of regular turnover, where it is all very, very choppy. So step number 2, what we do with step number 2, we look at the monthly GST turnover, look at the average monthly GST turnover. Total turnover for the 12 months was 525,000 divided by 12. So the average turnover is 43,750. Move on to step number 3. We multiply that by 3 to give us our average quarterly GST turnover, which is 131,250. And then we compare that to the $150,000 to the $100,000 GST turnover for September 2020 quarter. The decline has been 31,250, which represents 23.8%. So in this case here, they are not eligible for JobKeeper. Okay, so we'll move on to the next test, which is substantial increase in turnover test. Now, what might generate a substantial increase? One would be a business that expanded through acquisition. It could be a business that has won a sizable contract, or purely it has grown due to substantial organic growth. And there's three reasons why business will be a substantial increase. There could be other reasons as well. So if we go through the different steps, there's only 2 steps to this one. And I've got step number 3. I got a bit excited because I thought they might get JobKeeper. So step number 1 is that we must determine if there has been at least a substantial increase in GST turnover immediately before either of the applicable turnover test periods. So the test period can be made up of three different percentages. So there's either been a substantial increase over 12 months of 50%, a substantial increase over 6 months of 25%, or one over 3 months of 12.5%. But what's important to note here is that it's a month-to-month comparison. So if we look at the top line there, June 19 to June 2020, we look at the month of June 2019, compare it to the month of June 2020. We do not compare the year 1 July to June 19 and 1 July to June 2020. It is a month-by-month comparison. So basically, for this test, there are 6 opportunities to see whether you meet the substantial increase in turnover test. And on the assumption that you do, you compare the September 2020 GST turnover to the relevant quarter that aligns with the test month period. It's a bit of a mouthful, so let's go through an example to see how that works. So in this example, a business has September 2020 GST turnover of $150,000. The business has experienced an increase in GST turnover and want to determine if they can apply for JobKeeper. So what we're looking at in step number 1, we're comparing, in this case, the month of February 2019 to the month of February 2020. And there has been an increase of $30,000. That's a 60% increase, so therefore they meet the substantial increase in turnover test. So let's go to step number 2 to see whether we can determine whether this business qualifies for JobKeeper. So we look at the quarter of February 2020. So you look at December 19, June 2020, February 2020. Total GST turnover is $225,000. September 2020 is the GST turnover is 150 grand. The decline has been $75,000, which represents 33.33%. So in this case here, the business does qualify for JobKeeper. And what this really highlights when we've got 5 months, December 19, June 20, and February 20, if you don't lodge your BAS on a monthly basis, and then you really have to go into your records and determine what what the GST turnover is for that month. So it is a fair bit of work to pull out that data. So just something to be aware of that we just can't rely on BASs for this one. So that's the example for that. So that's about all I've got in terms of the alternative tests. And the final part of the presentation is related to JobKeeper key upcoming dates. Obviously the 28th of September is already passed, so we're in JobKeeper number 2 at the moment. And the month of October, you can see why businesses and accountants are very busy at the moment. You must submit the monthly income declaration to the ATO for the final JobKeeper number 1 payments. and that's due in 8 days' time by the 14th of October. And by the end of October, we must submit our actual decline in turnover to the ATO. So we're informing the ATO that we do qualify for JobKeeper number 2. On the 31st of October, that's the latest date to meet the wage condition. What the wage condition is that's the last date that you must pay your employees the JobKeeper amounts for JobKeeper number 2. So I don't believe that will affect full-time employees, but any employees who may be receiving $1,000 a fortnight, you have to bump up their salary to $1,200 per fortnight. And between the 1st of November and the 14th of November, there's 2 things that we need to do. One, we must submit our monthly declaration for the October fortnights. So that way that covers JobKeeper number 2 for October. And as I mentioned a lot earlier on, is that we must advise the ATO of our payment tiers, whether eligible for the full rate or $1,200 per fortnight, or eligible for the reduced rate, which is $750 per fortnight. And they're the upcoming dates that we need to pay attention to. So I think that's about it for me, Nick. I think that's all I wanted to cover.
Thank you. We've actually got another question that's come up during the presentation. And the question is, by comparing the September quarter turnover with the September quarter turnover, this particular person believes they do not meet the 30% drop. But when they've looked at their invoicing, they've seen that there was an invoice raised in that September quarter, which wasn't paid until December. And so what they're saying is that if they then, I presume that it looks like the question is if they then treat that invoice as being a December recognition, perhaps because they're on cash basis for GST, that satisfies the decline in turnover and therefore they meet the tax office requirements. I think sometimes the issue can be around cash versus accruals for clients as well. We're seeing with JobKeeper.
Yeah, that's exactly true. So it's all predicated on how you lodge your BAS. If you're lodging a BAS on your cash basis, yes, in that example there, you would not include that income in the September 2020 quarter. But if you're lodging a BAS on an accruals basis, then you do need to include that income in your September 2020 quarter. You can't change your BAS reporting from accruals to cash in September 2020, then compare that to September 19 when you reported on accruals. It's got to be very consistent. So September 19, you recorded everything you lodged your BAS on an accruals basis. Then September 2020, you must also look at the GST turnover test on an accruals basis as well.
Yep. Thanks, Mark. The second follow-up question is, the client or the taxpayer appears to be eligible for JobKeeper 2.0, which has just commenced last week. Payroll's coming up very soon, might be in the next couple of days. Should they continue to pay their employees and wait for the top-up JobKeeper payment, or how would you recommend people deal with that situation where they might get the JobKeeper payment for maybe a couple of weeks?
Okay, so this is where they qualify for JobKeeper number 2.
Yeah, on the presumption that a person thinks or a business thinks that they qualify for JobKeeper, should they continue to pay their staff on the basis
Okay, so I look at the slide that's in front of me. So 4th line there, 31st of October. So you don't have to meet your JobKeeper obligations for JobKeeper number 2 until the 31st of October. So if you're on the borderline thinking, geez, am I going to qualify or not? It may be best to hold back, wait till you're 100% certain that you do qualify for JobKeeper number 2, then meet that wage condition and pay that JobKeeper payment by the 31st of October.
Yeah, because a few steps involved, isn't there, Mark? Business is going to have to reconcile their figures for the September quarter, establish their GST turnover, make the assessment of the basic eligibility requirement of 30% drop. If they don't satisfy that, then it's look at alternative tests. Then once you determine you satisfy alternative test, make an application to the tax office, then go through and hopefully get your JobKeeper. So there's a few steps there.
Well, there's a lot of work to do between now to the end of October. So, I mean, the key thing is, even though you may not lodge your BAS lien, if you use us as an agent, we can lodge to the 25th of November, but I wouldn't be relying on that. You have to be 100% sure about your GST turnover well before the 31st of October. You don't want to leave it to the last minute. You'd rather be on top of it and look at it and have it submitted, hopefully by mid-month to maybe by the 20th at the latest, I would recommend. Because you want to be 100% certain with your calculations.
Yeah, the best thing I think clients can do at this point is keep the communication with your accountant, present the information, the facts, and we can help to either make the assessment or help expedite the actual application process.
Oh, that's exactly true.
Question from Christine. Christine has a question around lodging their GST on a cash basis. They have a large annual invoice that was paid late by a client. They paid in June. It was paid in July. With the large amount in our cash reporting for the September quarter, we have a slight increase rather than a decrease. How do we qualify? So it appears the issue there is that we have a person who's on a cash basis for GST. Money is coming to the September 20 quarter as a receipt, which is then reported for GST purposes. What can someone in that situation do around JobKeeper assessment?
With that, there's no easy fix on that one, because the GST for the BAS, or the BAS is predicated again on when you receive the money under the cash basis. So if you receive it in July, you're obligated to report that in your BAS for the September quarter. You cannot back that out and put it into June because you never received it. You never received that in June, even though it was invoiced in June.
So what you're talking about is a statement of fact, isn't it? I mean, that you're reporting on cash is a statement of fact. There's not much you can do about it, unfortunately. It's just what you've received.
Oh, is it? No. I mean, what the fact is that the money's being deposited into the bank account. So if the ATO was to do an audit, I'll see on that date here, you'll receive $50,000. So therefore, it must be in your GST turnover for the September quarter.
Yeah, great. What we'll do there, I think, is we've got a couple more questions. But what we might do is, I think we've come to the time limit for the presentation. So thank you very much, Mark, for participating in today's presentation and putting forward that information. It's very timely and very important to our clients to hear this. There are a couple of specific questions people do have on the question and answer. So what we'll do for those attendees is we will be sharing the slides to anyone who would like that. So please contact Christine and our marketing department to get a copy of those slides. We're happy to share those, and we'll also answer your questions specifically as they relate to you. So once again, Mark, thank you for today's presentation. Just a reminder to everyone who attended today's presentation is on Thursday, we're doing a budget update. Myself and Chris Wilson will be presenting on the budget changes which are being announced tonight. And so we will be informing you on all of the items, particularly tax related issues that may affect you and your position in the next little period of time. And it's a pretty important budget given the government is talking about spending what they're saying is an unprecedented amount of funds and giving some quite serious incentives for individuals and business to continue to operate. So thank you all once again. I look forward to seeing you soon, and thank you, Mark, and good luck with the rest of your day.
Thank you, everyone.